Open a ZERODHA account. Chapter 3. Bull Put Spread. 3.1 Why Bull Put Spread? Similar to the bull call spread. The bull put spread is a two-leg option strategy invoked when the view on the market is moderately bullish. The bull put spread is similar to the bull call spread in terms of the payoff structure. However, there are a few differences in terms of strategy execution and strike selection. The bull put spread involves creating a spread by employing put options rather than call options, as is the case in bull call spread. You may have a fundamental question at this stage when the payoffs from both bull call spread and bull put spread are similar. Why should one choose a certain strategy over the other? Well, this really depends on how attractive the premiums are. While the bull call spread is executed for a debit, the bull put spread is executed for a credit. So if you are at a point in the market where the markets have declined considerably, therefore put premiums have swelled, the volatility is on the higher side, there is plenty of time to expiry, and you have a moderately bullish outlook looking ahead, then it makes sense to invoke a bull put spread for a net credit as opposed to invoking a bull call spread for a net debit. Personally, I do prefer strategies which offer net credit rather than strategies which offer net debit. 3.2 Strategy Notes. The bull put spread is a two-leg spread strategy traditionally involving ITM and OTM put options. However, you can create the spread using other strikes as well. To implement the bull put spread, buy one OTM put option, leg 1. Sell one ITM put option, leg 2. When you do this, ensure all strikes belong to the same expiry series. Each leg involves the same number of options. For example, date the 7th of December 2015. Outlook, moderately bullish, expect the market to go higher. Nifty spot 7,805. Bull put spread. Trade set up. Buy 7,700, pay by paying 72 rupees per as premium. Do note this is an OTM option. Since money is going out of my account, this is a debit transaction. Sell 7,900, pay and receive 163 rupees per as premium. Do note this is an ITM option. Since I receive money, this is a credit transaction. The net cash flow is the difference between the debit and credit, i.e. 163 to 72 equals plus 91. Since this is a positive cash flow, there is a net credit to my account. Generally speaking, in a bull put spread there is always a net credit. Hence the bull put spread is also referred to as a credit spread. After we initiate the trade, the market can move in any direction and expiry at any level. Therefore, let us take up a few scenarios to get a sense of what would happen to the bull put spread for different levels of expiry. Scenario 1. Market expires at 7,600, below the lower strike price, i.e. OTM option. The value of the put options at expiry depends upon its intrinsic value. If you recall from the previous module, the intrinsic value of a put option upon expiry is max strike spot O. In case of 7,700 pay, the intrinsic value would be max 77007600 equals max 100. 0 equals 100. Since we are long on the 7,700 pay by paying a premium of 72 rupees, we would make equals premium paid intrinsic value equals 100 to 72 equals 28. Likewise, in case of the 7,900 pay option, it has an intrinsic value of 300. But since we have written this option at 163 rupees, payoff from 7,900 pay, this would be 163 to 300 equals 137. Overall strategy payoff would be plus 28 to 137 equals 109. Scenario 2. Market expires at 7,700 at the lower strike price, i.e. the OTM option. The 7,700 pay will not have any intrinsic value. Hence we will lose all the premium that we have paid, i.e. 72 rupees. The 7,900 PE's intrinsic value will be 200 rupees. Net payoff from the strategy would be Premium received from selling 7900p. Intrinsic value of 7,900 pay. Premium lost on 7,700 pay. Equals 163,272. Equals 109. Scenario 3. Market expires at 7,900 at the higher strike price, i.e. ITM option. The intrinsic value of both 7,700 pay and 7,900 pay would be 0. Hence both the potions would expire worthless. Net payoff from the strategy would be premium received for 7,900 pay, premium paid for 7,700 pay, equals 163 to 72, equals plus 91. Scenario 4. Market expires at 8,000 above the higher strike price, i.e. the ITM option. Both the options, i.e. 7,700 pay and 7,900 pay, would expire worthless. Hence the total strategy payoff would be premium received for 7,900 pay, premium paid for 7,700 pay, equals 163 to 72, equals plus 91. To summarize, market expiry 7,700 pay, intrinsic value 7,900 pay, intrinsic value, net payoff 7600 100 300 109, 7700 200 109, 7900 0091, 8000 0091. From this analysis, 3 things should be clear to you. The strategy is profitable as in when the market moves higher, irrespective of the down move in the market. The loss is restricted to 109 rupees. The maximum loss also happens to be the difference between spread and net credit of the strategy. The maximum profit is capped to 91. This also happens to be the net credit of the strategy. We can define the spread as spread equals difference between the higher and lower strike price. We can calculate the overall profitability of the strategy for any given expiry value. Here is a screenshot of the calculations that I made on the Excel sheet. LSIV, lower strike, intrinsic value, 7,700 pay. OTM, PP, premium paid. LS payoff, lower strike payoff. HSIV, higher strike, intrinsic value, 7,900 pay. ITM, PR, premium received. HS payoff, higher strike payoff. As you can notice, the loss is restricted to 109 rupees, and the profit is capped to 91 rupees. Given this, we can generalize the bull put spread to identify the max loss and max profit levels as bull put spread max loss equals spread net credit. Net credit equals premium received for higher strike, premium paid for lower strike. Bull put spread max profit equals net credit. This is how the payoff diagram of the bull put spread looks like. There are 3 important points to note from the payoff diagram. The strategy makes a loss if Nifty expires below 7,700. However, the loss is restricted to 109 rupees. The break-even point where the strategy neither make a profit or loss is achieved when the market expires at 7,809. Therefore, we can generalize the break-even point for a bull put spread as higher strike net credit. The strategy makes money if the market moves above 7,809. However, the maximum profit achievable is 91 rupees, i.e. the difference between the premium received for ITM pay and the premium paid for the OTM pay. Premium paid for 7,700 pay equals 72. Premium received for 7,900 pay equals 163. Net credit equals 163 to 72 equals 91. 3.3 Other strike combinations. Remember, the spread is defined as the difference between the 2 strike prices. The bull put spread is always created with 1 OTM put and 1 ITM put option. However, the strikes that you choose can be any OTM and any ITM strike. The further these strikes are, the larger the spread. The larger the spread, the larger is possible reward. Let us take some examples considering spot is at 7,612. Bull put spread with 7,500 pay OTM and 7,700 pay ITM. Lower strike OTM. Long 7,500. Higher strike ITM. Short 7,700. Spread 7,700,7,500 equals 200. Lower strike premium paid 62. Higher strike premium received 137. Net credit 137 to 62 equals 75. Max loss spread net credit 200 to 75 equals 125. Max profit net credit 75. Break even higher strike net credit 7,775 equals 7,625. Bull put spread with 7,400 pay OTM and 7,800 pay ITM. Lower strike OTM. Long 7,400. Higher strike ITM. Short 7,800. Spread 7,800,7,400 equals 400. Lower strike premium paid 40. Higher strike premium received 198. Net credit 198 to 40 equals 158. Max loss spread net credit 400 to 158 equals 242. Max profit net credit 158. Break even higher strike net credit 7,800,158 equals 7,642. Bull put spread with 7,500 pay OTM and 7,800 pay ITM. Lower strike OTM. Long 7,500. Higher strike ITM. Short 7,800. Spread 7,800,7,500 equals 300. Lower strike premium paid 62. Higher strike premium received 198. Net credit 198 to 62 equals 136. Max loss spread net credit 300 to 136 equals 164. Max profit net credit 136. Break even higher strike net credit 7,800,136 equals 7,664. So the point here is that you can create the spread with any combination of OTM and ITM option. However, based on the strikes that you choose and therefore the spread you create, the risk-reward ratio changes. In general, if you have a high conviction on a moderately bullish view, then go ahead and create a larger spread. Else stick to a smaller spread. Download the Bull Put Spread Excel. Key takeaways from this chapter. The Bull Put Spread is an alternative to the Bull Call Spread. It's best executed when the outlook on the market is moderately bullish. Bull Put Spread results in a net credit. The Bull Put Spread is best executed when the market has cracked. Put premiums are high. The volatility is on the higher side. And you expect the market to hold up without cracking further. The Bull Put strategy involves simultaneously buying a OTM put option and selling a ITM put option. Maximum profit is limited to the extent of the net credit. Maximum loss is limited to the spread minus net credit. Break-even is calculated as higher strike net credit. One can create the spread by employing any OTM and ITM strikes. Higher the spread, higher the profit potential, and higher the break-even point. 52 responses to Bull. Open a ZERODHA account. Chapter 4. Call Ratio Back Spread. 4.1 Background. The call ratio back spread is an interesting options strategy. I call this interesting keeping in mind the simplicity of implementation and the kind of payoff it offers the trader. This should certainly have a spot in your strategy arsenal. The strategy is deployed when one is outrightly bullish on a stock or index. Unlike the bull call spread or bull put spread where one is moderately bullish. At a broad level, this is what you will experience when you implement the call ratio back spread. Unlimited profit if the market goes up. Limited profit if market goes down. A predefined loss if the market stay within a range. In simpler words, you can get to make money as long as the market moves in either direction. Usually, the call ratio back spread is deployed for a net credit, meaning money flows into your account as soon as you execute call ratio back spread. The net credit is what you make if the market goes down, as opposed to your expectation, i.e. market going up. On the other hand, if the market indeed goes up, then you stand to make an unlimited profit. I suppose this should also explain why the call ratio spread is better than buying a plain vanilla call option. So let's go ahead and figure out how this works. 4.2 Strategy Notes. The call ratio back spread is a three-leg option strategy as it involves buying 2 ATM call option and selling 1 ATM call option. This is the classic 2-to-1 combo. In fact, the call ratio back spread has to be executed in the 2-to-1 ratio, meaning 2 options bought for every 1 option sold, or 4 options bought for every 2 options sold, so on and so forth. Let's take an example. Assume Nifty spot is at 7,743 and you expect Nifty to hit 8,100 by the end of expiry. This is clearly a bullish outlook on the market. To implement the call ratio back spread, sell 1 lot of 7,600 CE ITM. Buy 2 lots of 7,800 CE OTM. Make sure the call options belong to the same expiry, belongs to the same underlying. The ratio is maintained. The trade setup looks like this. 7,600 CE. 1 lot short. The premium received for this is 201 rupees per 7,800 CE. 2 lots long. The premium paid is 78 rupees per lot. So 156 rupees per for 2 lots. Net cash flow is equals premium received, premium paid, i.e. 201 to 156 equals 45 net credit. With these trades, the call ratio back spread is executed. Let us check what would happen to the overall cash flow of the strategies at different levels of expiry. Do note we need to evaluate the strategy payoff at various levels of expiry as the strategy payoff is quite versatile. Scenario 1: market expires at 7,400 below the lower strike price. We know the intrinsic value of a call option upon expiry is max spot strike 0. The 7,600 would have an intrinsic value of max 7400-7600. 0 equals 0. Since we have sold this option, we get to retain the premium received, i.e. 201 rupees. The intrinsic value of 7,800 call option would also be 0. Hence we lose the total premium paid, i.e. 78 rupees per lot or 156 rupees for 2 lots. Net cash flow would premium received, premium paid equals 201 to 156 equals 45. Scenario 2: market expires at 7,600 at the lower strike price. The intrinsic value of both the call options, i.e. 7,600 and 7,800, would be 0. Hence both of them expire worthless. We get to retain the premium received, i.e. 201 rupees towards the 7,600 CE. However, we lose 156 rupees on the 7,800 CE, resulting in a net payoff of 45 rupees. Scenario 3: market expires at 7,645 at the lower strike price plus net credit. You must be wondering why I picked the 7,645 level. Well, this is to showcase the fact that the strategy break-even is at this level. The intrinsic value of 7,600 CE would be max spot strike 0 equals 76457600. 0 equals 45. Since we have sold this option for 201, the net payoff from the option would be 201 to 45 equals 156. On the other hand, we have bought 2 7,800 CE by paying a premium of 156. Clearly, the 7,800 CE would expire worthless, hence we lose the entire premium. Net payoff would be 156 to 156 equals 0. So at 7,645, the strategy neither makes money or loses any money for the trader. Hence 7,645 is treated as a break-even point for this trade. Scenario 4 market expires at 7,700, halfway between the lower and higher strike price. The 7600 CE would have an intrinsic value of 100. And the 7800 would have no intrinsic value. On the 7600 CE, we get to retain 101. As we would lose 100 from the premium received of 201, i.e. 201 to 100 equals 101. We lose the entire premium of 156 rupees on the 7800 CE. Hence the total payoff from the strategy would be equals 101 to 156 equals 55. Scenario 5 market expires at 7,800 at the higher strike price. This is an interesting market expiry level. Think about it. At 7,800, the 7600 CE would have an intrinsic value of 200. And hence we have to let go of the entire premium received, i.e. 201. At 7,800, the 7800 CE would expire worthless, hence we lose the entire premium paid for the 7800 CE, i.e. 78 rupees per lot. Since we have two of these, we lose 156 rupees. So this is like a double whammy point for the strategy. The net payoff for the strategy is premium received for 7600 CE, intrinsic value of 7600 CE, premium paid for 7800 CE, equals 201, 200, 156, equals minus 155. This also happens to be the maximum loss of this strategy. Scenario 6 market expires at 7,955, higher strike, i.e. 7,800 plus max loss. I've deliberately selected this strike to showcase the fact that at 7,955 the strategy break even. But we dealt with a break even earlier. You may ask, well, this strategy has two break-even points, one on the lower side, 7,645, and another one on the upper side, i.e. 7,955. At 7,955, the net payoff from the strategy is premium received for 7600 CE, intrinsic value of 7600 CE plus 2 asterisk intrinsic value of 7800 CE. Premium paid for 7800 CE equals 201 to 355 plus 2 asterisk 155 156 equals 201 to 355 plus 310 to 156 equals 0. Scenario 7 market expires at 8,100, higher than the higher strike price. Your expected target. The 7600 CE will have an intrinsic value of 500. And the 7800 CE will have an intrinsic value of 300. The net payoff would be premium received for 7600 CE, intrinsic value of 7600 CE plus 2 asterisk intrinsic value of 7800 CE. Premium paid for 7800 CE equals 201 to 500 plus 2 asterisk 300 156 equals 201 to 500 plus 600 to 156 equals 145. Here are various other levels of expiry and the eventual payoff from the strategy. Denote: as the market goes up, so does the profits. But when the market goes down, you still make some money, although limited. 4.3 Strategy Generalization. Going by the above discussed scenarios, we can make few generalizations. Spread equals higher strike, lower strike. Net credit equals premium received for lower strike 2 asterisk premium of higher strike. Max loss equals spread, net credit. Max loss occurs at equals higher strike. The payoff when market goes down equals net credit. Lower break-even equals lower strike plus net credit. Upper break-even equals higher strike plus max loss. Here is a graph that highlights all these important points. Notice how the payoff remains flat even when the market goes down. The maximum loss at 7,800. And the way the payoff takes off beyond 7,955. 4.4 Welcome back, the Greeks. I suppose you are familiar with these graphs by now. The following graphs show the profitability of the strategy considering the time to expiry, and therefore these graphs help the trader select the right strikes. Before understanding the graphs above, note the following. Nifty spot is assumed to be at 8,000. Start of the series is defined as any time during the first 15 days of the series. End of the series is defined as any time during the last 15 days of the series. The call ratio back spread is optimized and the spread is created with 300 points difference. The thought here is that the market will move up by about 6.25%, i.e. from 8,000 to 8,500. So considering the move and the time to expiry, the graphs above suggest Graph 1, top left, and Graph 2, top right, you are at the start of the expiry series and you expect the move over the next 5 days and 15 days in case of Graph 2. Then a call ratio spread with 7,800 CE ITM and 8,100 CE OTM is the most profitable, wherein you would sell 7,800 CE and buy 8,100 CE. Do note, even though you would be right on the direction of movement, selecting other far OTM strikes call options tend to lose money. Graph 3, bottom left, and Graph 4, bottom right, you are at the start of the expiry series and you expect the move in 25 days and expiry day in case of Graph 3. Then a call ratio spread with 7,800 CE ITM and 8,100 CE OTM is the most profitable, wherein you would sell 7,800 CE and buy 8,100 CE. You must be wondering that the selection of strikes is same irrespective of time to expiry. Well, yes. In fact, this is the point. Call ratio back spread works best when you sell slightly ITM option and buy slightly OTM option when there is ample time to expiry. In fact, all other combinations lose money, especially the ones with far OTM options, and especially when you expect the target to be achieved closer to the expiry. Here are another bunch of charts. The only difference is that the move, i.e. 6.25%, occurs during the second half of the series. Graph 1, top left, and Graph 2, top right, if you expect the move during Graph 1, top left, and Graph 2, top right, if you expect the move during the second half of the series, and you expect the move to happen within a day or within 5 days. Graph 2, then the best strikes to opt are deep ITM and slightly ITM, i.e. 7,600 lower strike short and 7,900 higher strike long. Denote: this is not the classic combo of an ITM plus OTM spread. Instead, this is an ITM and ITM spread. In fact, all other combinations don't work. Graph 3, bottom right, and Graph 4, bottom left, if you expect the move during the second half of the series, and you expect the move to happen within 10 days or on expiry day. Graph 4, then the best strikes to opt are deep ITM and slightly ITM, i.e. 7,600 lower strike short and 7,900 higher strike long. This is similar to what Graph 1 and Graph 2 suggest. Again, the point to note here is besides getting the direction right, the strike selection is the key to the profitability of this strategy. One needs to be diligent enough to map the time to expiry to the right strike to make sure that the strategy works in your favor. What about the effect of volatility on this strategy? Well, volatility plays a key role here. Have a look at the image below. There are 3 colored lines depicting the change of net premium, aka the strategy payoff versus change in volatility. These lines help us understand the effect of increase in volatility on the strategy, keeping time to expiry in perspective. Blue line. This line suggests that an increase in volatility when there is ample time to expiry 30 days is beneficial for the call ratio back spread. As we can see, the strategy payoff increases from -67 to +43 when the volatility increase from 15% to 30%. Clearly, this means that when there is ample time to expiry, besides being right on the direction of stock index, you also need to have a view on volatility. For this reason, even though I'm bullish on this stock, I would be a bit hesitant to deploy this strategy at the start of the series if the volatility is on the higher side, say more than double of the usual volatility reading. Green line. This line suggests that an increase in volatility when there are about 15 days time to expiry is beneficial, although not as much as in the previous case. As we can see, the strategy payoff increases from -77 to -47 when the volatility increase from 15% to 30%. Red line. This is an interesting counterintuitive outcome. When there are very few days to expiry, increase in volatility has a negative impact on the strategy. Think about it. Increase in volatility when there are few days to expiry enhances the possibility of the option to expiry OTM. Hence the premium decreases. So, if you are bullish on a stock index with few days to expiry, and you also expect the volatility to increase during this period, then tread cautiously. Download the call ratio back spread Excel sheet. Key takeaways from this chapter. The call ratio back spread is best executed when your outlook on the stock index is bullish. The strategy requires you to sell 1 ITMCE and buy 2 OTMCE. And this is to be executed in the same ratio, i.e. for every one sold option, 2 options have to be purchased. The strategy is usually executed for a net credit. The strategy makes limited money if the stock price goes down, and unlimited profit if the stock price goes up. The loss is predefined. There are 2 break-even points, lower break-even and upper break-even points. Spread equals higher strike, lower strike. Net credit equals premium received for lower strike 2 * premium of higher strike. Max loss equals spread, net credit. Max loss occurs at equals higher strike. The payoff when market goes down equals net credit. Lower break-even equals lower strike plus net credit. Upper break-even equals higher strike plus max loss. Irrespective of the time to expiry, opt for slightly ITM plus slightly OTM combination of strikes. Increase in volatility is good for this strategy when there is more time to expiry. But when there is less time to expiry, increase in volatility is not really good for this strategy. Open a ZERODHA account. Chapter 5. Bear Call Letter. 5.1 Background. The bear in the bear call letter should not deceive you to believe that this is a bearish strategy. The bear call letter is an improvisation over the call ratio back spread. This clearly means you implement this strategy when you are outrightly bullish on the stock index. In a bear call letter, the cost of purchasing call options is financed by selling an in-the-money call option. Further, the bear call letter is also usually set up for a net credit, where the cash flow is invariably better than the cash flow of the call ratio back spread. However, do note that both these strategies showcase similar payoff structures but differ slightly in terms of the risk structure. 5.2 Strategy Notes. The bear call letter is a 3-leg option strategy, usually set up for a net credit, and it involves selling 1 ITM call option, buying 1 ITM call option, buying 1 OTM call option. This is the classic bear call letter setup, executed in a 1-1-to-1 combination. The bear call letter has to be executed in the 1-1-to-1 ratio, meaning for every 1 ITM call option sold, 1 ATM and 1 OTM call option has to be bought. Other combination like 2, 2 to 2 or 3, 3 to 3, so on and so forth is possible. Let's take an example. Assume Nifty spot is at 7,790 and you expect Nifty to hit 8,100 by the end of expiry. This is clearly a bullish outlook on the market. To implement the bear call ladder, sell 1 ATM call option. Buy 1 ATM call option. Buy 1 OTM call option. Make sure the call options belong to the same expiry. Belongs to the same underlying. The ratio is maintained. The trade setup looks like this. 7600 CE. 1 lot short. The premium received for this is 247 rupees per 7800 CE. 1 lot long. The premium paid for this option is 117 rupees per 7900 CE. 1 lot long. The premium paid for this option is 70 rupees per. The net credit would be 247,117,70 equals 60. With these trades, the bear call ladder is executed. Let us check what would happen to the overall cash flow of the strategies at different levels of expiry. Do note we need to evaluate the strategy payoff at various levels of expiry as the strategy payoff is quite versatile. Scenario 1 market expires at 7,600 below the lower strike price. We know the intrinsic value of a call option upon expiry is max spot strike 0. The 7,600 would have an intrinsic value of max 7600 0 equals 0. Since we have sold this option, we get to retain the premium received, i.e. 247 rupees per. Likewise, the intrinsic value of 7800 CE and 7900 CE would also be 0. Hence we lose the premium paid, i.e. 117 rupees and 70 rupees respectively. Net cash flow would premium received premium paid equals 247,117,70 equals 60. Scenario 2 market expires at 7,660 lower strike plus net premium received. The 7600 CE would have an intrinsic value of max spot strike 0. The 7,600 would have an intrinsic value of max 7660 0 equals 60. Since the 7600 is short, we will lose 60 from 247 and retain the balance equals 247 to 60 equals 187. The 7,800 and 7,900 CE would expire worthless. Hence we lose the premium paid, i.e. 117 and 70 respectively. The total strategy payoff would be equals 187,117,70 equals 0. Hence at 7,660, the strategy would neither make money nor lose money. Hence this is considered a lower break-even point. Scenario 3 market expires at 7,700 between the break-even point and middle strike, i.e. 7,660 and 7,800. The intrinsic value of 7,600 CE would be max spot strike 0 equals 7700 0 equals 100. Since we have sold this option for 247, the net payoff from the option would be 247 to 100 equals 147. On the other hand, we have bought 7,800 CE and 7,900 CE, both of which would expire worthless. Hence we lose the premium paid for these options, i.e. 117 and 70 respectively. Net payoff from the strategy would be 147,117,70 equals 40. Scenario 4 market expires at 7,800 at the middle strike price. Pay attention here, as this is where the tragedy strikes. The 7,600 CE would have an intrinsic value of 200. Considering we have written this option for a premium of 247 rupees, We stand to lose the intrinsic value, which is 200 rupees. Hence on the 7600 CE, we lose 200 and retain 247 to 200 equals 47. Both 7800 CE and 7900 CE would expire worthless. Hence the premium that we paid goes waste, i.e. 117 and 70 respectively. Hence our total payoff would be 47,11770 equals minus 140. Scenario 5 market expires at 7,900 at the higher strike price. Pay attention again. Tragedy strikes again, smiley face. The 7600 CE would have an intrinsic value of 300. Considering we have written this option for a premium of 247 rupees, we stand to lose all the premium value plus more. Hence on the 7600 CE, we lose 247 to 300 equals minus 53. Both 7800 CE would have an intrinsic value of 100. Considering we have paid a premium of 117 rupees, the payoff for this option would be 100 to 117 equals 17. Finally, 7900 CE would expire worthless. Hence the premium paid, i.e. 70, would go waste. The final strategy payoff would be minus 5317 to 70 equals minus 140. Denote: the loss at both 7,800 and 7,900 is the same. Scenario 6 market expires at 8,040, sum of long strike minus short strike minus net premium. Similar to the call ratio back spread, the bear call ladder has two break-even points, i.e. the upper and lower break-even. We evaluated the lower break-even earlier, scenario 2. And this is the upper break-even point. The upper break-even is estimated as 7,900 plus 7,800, 7,660 equals 15700, 760060 equals 8,160 equals 8,040. Denote: both 7,900 and 7,800 are strikes we are long on, and 7,600 is the strike we are short on. 60 is the net credit. So at 8,040, all the call options would have an intrinsic value. 7600 CE would have an intrinsic value of 8040, 7600 equals 440. Since we are short on this at 247, we stand to lose 247 to 440 equals minus 193. 7800 CE would have an intrinsic value of 8040, 7800 equals 240. Since we are long on this at 117, we make 240 to 117 equals plus 123. 7900 CE would have an intrinsic value of 8040, 7900 equals 140. Since we are long on this at 70, we make 140 to 70 equals plus 70. Hence the total payoff from the bear call ladder would be minus 193 plus 123 plus 70 equals 0. Hence at 8,040, the strategy would neither make money nor lose money. Hence this is considered a upper break-even point. Denote: at 7,800 and 7,900 the strategy was making a loss, and at 8,040 the strategy broke even. This should give you a sense that beyond 8,040, the strategy would make money. Let's just validate this with another scenario. Scenario 7 market expires at 8,300. At 8,300 all the call options would have an intrinsic value. 7600 CE would have an intrinsic value of 8300, 7600 equals 700. Since we are short on this at 247, we stand to lose 247 to 700 equals minus 453. 7800 CE would have an intrinsic value of 8300, 7800 equals 500. Since we are long on this at 117, we make 500 to 117 equals plus 383. 7900 CE would have an intrinsic value of 8300,7900 equals 400. Since we are long on this at 70, we make 400 to 70 equals plus 330. Hence the total payoff from the bear call ladder would be minus 453 plus 383 plus 330 equals 260. As you can imagine, the higher the market move, the higher is the profit potential. Here is a table that gives you the payoffs at various levels. Do notice, when the market goes below, you stand to make a modest gain of 60 points. But when the market moves up, the profits are uncapped. 5.3 Strategy Generalization. Going by the above discussed scenarios, we can make few generalizations. Spread equals, technically this is a ladder and not really a spread. However, the first two option legs creates a classic spread wherein we sell ITM and buy ATM. Hence the spread could be taken as the difference between the ITM and ITM options. In this case it would be 200, 7800, 7600. Net credit equals premium received from ITM CE, premium paid to ATM and OTM CE. Max loss equals spread difference between the ITM and ITM options, net credit. Max loss occurs at equals ATM and OTM strike. The payoff when market goes down equals net credit. Lower break-even equals lower strike plus net credit. Upper break-even equals sum of long strike minus short strike minus net premium. Here is a graph that highlights all these important points. Notice how the strategy makes a loss between 7,660 and 8,040, but ends up making a huge profit if the market moves past 8,040. Even if the market goes down, you still end up making a modest profit. But you are badly hit if the market does not move at all. Given this characteristics of the bear call ladder, I would suggest you implement the strategy only when you are absolutely sure that the market will move, irrespective of the direction. From my experience, I believe this strategy is best executed on stocks rather than index when the quarterly results are due. 5.4 Effective Greeks. The effective Greeks on this strategy is very similar to the effective Greeks on call ratio back spread, especially the volatility bit. For your easy reference, I'm reproducing the discussion on volatility we had in the previous chapter. There are three colored lines depicting the change of net premium, aka the strategy payoff versus change in volatility. These lines help us understand the effective increase in volatility on the strategy, keeping time to expiry in perspective. Blue line. This line suggests that an increase in volatility when there is ample time to expiry, 30 days, is beneficial for the bear call ladder spread. As we can see, the strategy payoff increases from minus 67 to plus 43 when the volatility increase from 15% to 30%. Clearly, this means that when there is ample time to expiry. Besides being right on the direction of stock index, you also need to have a view on volatility. For this reason, even though I'm bullish on this stock, I would be a bit hesitant to deploy this strategy at the start of the series if the volatility is on the higher side, say more than double of the usual volatility reading. Green line. This line suggests that an increase in volatility when there are about 15 days time to expiry is beneficial, although not as much as in the previous case. As we can see, the strategy payoff increases from minus 77 to minus 47 when the volatility increase from 15% to 30%. Red line. This is an interesting, counterintuitive outcome. When there are very few days to expiry, increase in volatility has a negative impact on the strategy. Think about it. Increase in volatility when there are few days to expiry enhances the possibility of the option to expiry OTM. Hence the premium decreases. So, if you are bullish on a stock index with few days to expiry, and you also expect the volatility to increase during this period, then tread cautiously. Download the Bear Call Ladder Excel. Key takeaways from this chapter. Bear call ladder is an improvisation over the call ratio spread. Invariably, the cost of executing a bear call ladder is better than the call ratio spread. But the range above which the market has to move also becomes large. The bear call ladder is executed by selling 1 ATM CE, buying 1 ATM CE, and 1 OTM CE. Net credit equals premium received from ITM CE, premium paid to ATM and OTM CE. Max loss equals spread difference between the ITM and ITM options, net credit. Max loss occurs at equals ATM and OTM strike. The payoff when market goes down equals net credit. Lower break-even equals lower strike plus net credit. Upper break-even equals sum of long strike minus short strike minus net premium. Execute the strategy only when you are convinced that the market will move significantly higher. 44 responses to bear call ladder. Open a ZERODHA account. Chapter 6. Synthetic long and arbitrage. 6.1 Background. Imagine a situation where you would be required to simultaneously establish a long and short position on Nifty futures, expiring in the same series. How would you do this, and more importantly, why would you do this? We will address both these questions in this chapter. To begin with, let us understand how this can be done and later move ahead to understand why one would want to do this if you are curious. Arbitrage is the obvious answer. Options, as you may have realized by now, are highly versatile derivative instruments. You can use these instruments to create any kind of payoff structure, including that of the futures. Both long and short futures payoff. In this chapter, we will understand how we can artificially replicate a long futures payoff using options. However, before we proceed, you may want to just review the long futures linear payoff here. Alternatively, here is a quick overview. As you can see, the long futures position has been initiated at 2,360. And at that point you neither make money nor lose money. Hence the point at which you initiate the position becomes the break-even point. You make a profit as the futures move higher than the break-even point, and you make a loss lower. The futures move below the break-even point. The amount of profit you make for a 10-point up move is exactly the same as the amount of loss you'd make for a 10-point down move. Because of this linearity in payoff, the future is also called a linear instrument. The idea with a synthetic long is to build a similar long futures payoff using options. 6.2 Strategy Notes. Executing a synthetic long is fairly simple. All that one has to do is buy the ATM call option, sell the ATM put option. When you do this, you need to make sure the options belong to the same underlying, belongs to the same expiry. Let us take an example to understand this better. Assume Nifty is at 7,389, which would make 7,400 the ATM strike. Synthetic long would require us to go long on 7,400 CE. The premium for this is 107 rupees, and we would short the 7,400 pay at 80. The net cash outflow would be the difference between the two premiums, i.e. 107 to 80 equals 27. Let us consider a few market expiry scenarios. Scenario 1. Market expires at 7,200 below ATM. At 7,200, the 7,400 CE would expire worthless. Hence we would lose the premium paid, i.e. 107 rupees per. However, the 7,400 pay would have an intrinsic value, which can be calculated as follows. Intrinsic value of put option equals max strike spot 0 equals max 7400 7200 0 equals max 200 0 equals 200. Clearly, since we are short on this option, we would lose money from the premium we have received. The loss would be 80 to 200 equals minus 120. Total payoff from the long call and short put position would be equals minus 107 120. equals minus 227. Scenario 2, market expires at 7,400 at ATM. If the market expires exactly at 7,400, both the options would expire worthless and hence we lose the premium paid for the 7400 CE option, i.e. 107. We get to retain the premium for the 7400 pay option, i.e. 80. Net payoff from both the positions would be 27 E80 to 107. Denote: 27 also happens to be the net cash outflow of the strategy, which is also the difference between the two premiums. Scenario 3, market expires at 7,427 ATM plus difference between the two premiums. 7,427 is an interesting level. This is the break-even point for the strategy, where we neither make money nor lose money. 7400 CE, the option is ITM and has an intrinsic value of 27. However, we have paid 107 as premium, hence we experience a total loss of 80. 7,400 pay, the option would expire OTM. Hence we get to retain the entire premium of 80. On one hand we make 80 and the other we lose 80. Hence we neither make nor lose any money, making 7,427 the break-even point for this strategy. Scenario 4, market expires at 7,600 above ATM. At 7,600, the 7400 CE would have an intrinsic value of 200. We would make intrinsic value premium equals 200 to 107 equals 93. The 7,400 pay would expire worthless. Hence we get to retain the entire premium of 80 rupees. Total payoff from the strategy would be equals 93 plus 80 equals 173. With the above four scenarios, we can conclude that the strategy makes money while the market moves higher and loses money while the market goes lower, similar to futures. However, this still does not necessarily mean that the payoff is similar to that of futures. To establish that the synthetic long payoff behaves similar to futures, we need evaluate the payoff of the strategy with reference to the break-even point. Let's say 200 point above and below the break-even point. If the payoff is identical, then clearly there is linearity in the payoff, similar to futures. So let's figure this out. We know the break-even point for this is ATM plus difference between the premiums equals 7,400 plus 27 equals 7,427. The payoff around this point should be symmetric. We will consider 7,427 plus 200 equals 7,627 and 7,427 200 at 7,627. The 7400 CE would have an intrinsic value of 227. Hence we get to make 227 to 107 equals 120. The 7,400 pay would expire worthless. Hence we get to keep the entire premium of 80. In all, we experience a payoff of 120 plus 80 equals 200 at 7,227. The 7400 CE would not have any intrinsic value. Hence we lose the entire premium paid, i.e. 107. The 7,400 pay would have an intrinsic value of 7,400,7227 equals 173. Since we have received 80 as premium, the net loss would be 80 to 173 equals minus 93. In all, we experience a payoff of 93 to 107 equals minus 200. Clearly, there is payoff symmetry around the break-even. And for this reason, the synthetic long mimics the payoff of the long futures instrument. Further, here is the payoff at various expiry levels. And when you plot the net payoff, we get the payoff structure, which is similar to the long call futures. Having figured out how to set up a synthetic long, we need to figure out the typical circumstances under which setting up a synthetic long is required. 6.3 The fish market arbitrage. I'll assume that you have a basic understanding on arbitrage. In easy words, arbitrage is an opportunity to buy goods, asset in a cheaper market and sell the same in expensive markets and pocket the difference in prices. If executed well, arbitrage trades are almost risk-free. Let me attempt to give you a simple example of an arbitrage opportunity. Assume you live by a coastal city with abundant supply of fresh sea fish. Hence the rate at which fish is sold in your city is very low. Let's say 100 rupees per kilogram. The neighboring city, which is 125 km away, has a huge demand for the same fresh sea fish. However, in this neighboring city the same fish is sold at 150 rupees per kilogram. Given this, if you can manage to buy the fish from your city at 100 rupees and manage to sell the same in the neighboring city at 150 rupees, then in process you clearly get to pocket the price differential, i.e. 50 rupees. Maybe you will have to account for transportation and other logistics. And instead of 50 rupees, you get to keep 30 rupees per kilogram. This is still a beautiful deal, and this is a typical arbitrage in the fish market. It looks perfect. Think about it, if you can do this every day, i.e. buy fish from your city at 100 rupees and sell in the neighboring city at 150 rupees. Adjust 20 rupees towards expenses, then 30 rupees per kg is guaranteed risk-free profit. This is indeed risk-free, provides nothing changes. But if things change, so will your profitability. Let me list few things that could change. No fish, opportunity risk. Assume one day you go to the market to buy fish at 100 rupees. And you realize there is no fish in the market. Then you have no opportunity to make 30 rupees per. No buyers, liquidity risk. You buy the fish at 100 rupees and go to the neighboring town to sell the same at 150 rupees. But you realize that there are no buyers. You are left holding a bag full of dead fish. Literally worthless. Bad bargaining, execution risk. The entire arbitrage opportunity hinges upon the fact that you can always bargain to buy at 100 rupees and sell at 150 rupees. What if on a bad day you happen to buy at 110 and sell at 140? You still have to pay 20 for transport. This means instead of the regular 30 rupees profit, you get to make only 10 rupees. And if this continues, then the arbitrage opportunity would become less attractive and you may not want to do this at all. Transport becomes expensive, cost of transaction. This is another crucial factor for the profitability of the arbitrage trade. Imagine if the cost of transportation increases from 20 rupees to 30 rupees. Clearly, the arbitrage opportunity starts looking less attractive as the cost of execution goes higher and higher. Cost of transaction is a critical factor that makes or breaks an arbitrage opportunity. Competition kicks in. Who can drop lower? Given that the world is inherently competitive, you are likely to attract some competition who would also like to make that risk-free 30 rupees. Now imagine this. So far you are the only one doing this trade, i.e. buy fish at 100 rupees and sell at 150 rupees. Your friend notices you are making a risk-free profit, and he now wants to copy you. You can't really prevent his, as this is a free market. Both of you buy at 100 rupees, transport it at 20 rupees, and attempt to sell it in the neighboring town. A potential buyer walks in, sees there is a new seller selling the same quality of fish. Who between the two of you is likely to sell the fish to the buyer? Clearly, given the fish is of the same quality, the buyer will buy it from the one selling the fish at a cheaper rate. Assume you want to acquire the client, and therefore drop the price to 145 rupees per. Next day your friend also drops the price and offers to sell fish at 140 rupees per kg, and therefore igniting a price war. In the whole process the price keeps dropping and the arbitrage opportunity just evaporates. How low can the price drop? Obviously it can drop to 120 rupees, cost of buying fish plus transport. Beyond 120, it does not make sense to run the business. Eventually, in a perfectly competitive world, competition kicks in and arbitrage opportunity just ceases to exist. In this case, the cost of fish in neighboring town would drop to 120 rupees or a price point in that vicinity. I hope the above discussion gave you a quick overview on arbitrage. In fact, we can define any arbitrage opportunity in terms of a simple mathematical expression. For example, with respect to the fish example, here is the mathematical equation. Cost of selling fish in town B, cost of buying fish in town A equals 20. If there is an imbalance in the above equation, then we essentially have an arbitrage opportunity. In all types of markets, fish market, agri market, currency market, and stock market, such arbitrage opportunities exist and they are all governed by simple arithmetic equations. 6.4 The options arbitrage. Arbitrage opportunities exist in almost every market. One needs to be a keen observer of the market to spot it and profit from it. Typically, stock market-based arbitrage opportunities allow you to lock in a certain profit, small but guaranteed, and carry this profit irrespective of which direction the market moves. For this reason, arbitrage trades are quite a favorite with risk-intolerant traders. I would like to discuss a simple arbitrage case here, the roots of which lie in the concept of put-call parity. I will skip discussing the put-call parity theory but would instead jump to illustrate one of its applications. However, I'd suggest you watch this beautiful video from Khan Academy to understand the put-call parity. So based on put-call parity, here is an arbitrage equation. Long synthetic long plus short futures equals 0. You can elaborate this too. Long ATM call plus short ATM put plus short futures equals 0. The equation states that the P&L upon expiry by virtue of holding a long synthetic long and short future should be 0. Why should this position result in a 0 P&L? Well, the answer to this is attributable to the put-call parity. However, if the P&L is a non-zero value, then we have an arbitrage opportunity. Here is an example that will help you understand this well. On the 21st of January, Nifty spot was at 7,304, and the Nifty futures was trading at 7,316. The 7300 CE and Pay ATM options were trading at 79.5 and 73.85 respectively. Denote. All the contracts belong to the January 2016 series. Going by the arbitrage equation stated above, if one were to execute the trade, the positions would be long 7300 CE at 79.5, short 7300 pay at 73.85, short Nifty futures at 7316. Denote. The first two positions together form a long synthetic long. Now as per the arbitrage equation, upon expiry the positions should result in a 0 P&L. Let's evaluate if this holds true. Scenario 1, expiry at 7200. The 7300 CE would expire worthless. Hence we lose the premium paid, i.e. 79.5. The 7300 pay would have an intrinsic value of 100. But since we are short at 73.85, the net payoff would be 73.85 to 100 equals minus 26.15. We are short on futures at 7316. Which would result in a profit of 116.7316720. Net payoff would be minus 79.526.15 plus 116 equals plus 10.35. Clearly, instead of a zero payoff, we are experiencing a positive non-zero P&L. Scenario 2, expiry at 7300. The 7300 CE would expire worthless. Hence we lose the premium paid, i.e. 79.5. The 7300 pay would expire worthless. Hence we get to retain 73.85. We are short on futures at 7316. Which would result in a profit of 16.7316730. Net payoff would be minus 79.5 plus 73.85 plus 16 equals plus 10.35. Scenario 3, expiry at 7400. The 7300 CE would have an intrinsic value of 100. And therefore the payoff would be 100 to 79.5 equals 20.5. The 7300 pay would expire worthless. Hence we get to retain 73.85. We are short on futures at 7316. Which would result in loss of 84.7316740. Net payoff would be 20.5 plus 73.85 to 84 equals plus 10.35. You could test this across any expiry value. In other words, the markets can move in any direction. But you are likely to pocket 10.35 points upon expiry. I'd like to stress this again. This arbitrage lets you make 10.35 upon expiry. Here is the payoff structure at different expiry values. Interesting, isn't it? But what's the catch, you may ask? Transaction charges. One has to account for the cost of execution of this trade and figure out if it still makes sense to take the trade. Consider this. Brokerage. If you are trading with a traditional broker, then you will be charged on a percentage basis which will eat away your profits. So on one hand you make 10 points, but you may end up paying 8 to 10 points as brokerage. However, if you were to do this trade with a discount broker like Zerodha, your break-even on this trade would be around 4 to 5 points. This should give you more reason to open your account with Zerodha smiley face. STT, do remember the P&L is realized upon expiry. Hence you would have to carry forward your positions to expiry. If you are long on an ITM option, which you will be, then upon expiry you will have to pay a hefty STT, which will further eat away your profits. Please do read this to know more. Other applicable taxes. Besides, you also have to account for service tax, stamp duty, etc. So considering these costs, the efforts to carry an arbitrage trade for 10 points may not make sense. But it certainly would, if the payoff was something better. Maybe like 15 or 20 points. With 15 or 20 points you can even maneuver the STT trap by squaring off the positions just before expiry, although it will shave off a few points. Download the Synthetic Long and Arbitrage Excel. Key takeaways from this chapter. You can use options to replicate futures payoff. A synthetic long replicates the long futures payoff. Simultaneously buying a TM call and selling a TM put creates a synthetic long. The break-even point for the synthetic long is the ATM strike plus net premium paid. An arbitrage opportunity is created when synthetic long plus short futures yields a positive non-zero P&L upon expiry. Execute the arbitrage trade only if the P&L upon expiry makes sense after accounting for expenses. 70 responses to synthetic long.